Everyone thinks the dollar is America's currency. That is one of the most expensive misconceptions in global finance. The dollar is indeed printed by the United States. But the dollar system, that has not belonged only to America for a long time. It is a global network. European banks borrow dollars, Asian companies take on dollar debt, emerging market countries hold reserves in dollars, commodities are priced in dollars, and when panic hits, everyone suddenly looks for the same thing: cash dollars, treasuries, or trusted short-term funding. This is where the problem begins. If the whole world uses dollars, but only one central bank can truly create them without limit, then this system is not merely a payment system. It is a global dependency machine. It looks calm while liquidity flows smoothly, then turns into an oxygen vacuum the moment funding starts to seize up. The media frames the dollar too simply. The dollar rises because the Fed is hawkish. The dollar falls because of rate cuts. The dollar is strong because the American economy is strong. All of that can be true, but it is only the front layer. The real question is not, is the dollar going up or down? The real question is, who needs dollars? Who is short dollars? And why do all emergency exits lead to the same room? For this system to make sense, we have to start with one simple idea. The world does not use the dollar only to buy goods. The world uses the dollar to survive financially. Imagine a company in Indonesia, Korea, Brazil, or Turkey. Its revenue is in local currency, but its machines, raw materials, debt, or bonds may be denominated in dollars. Why? Because global investors like dollars. Global banks like dollars. The dollar bond market is deeper. Its liquidity is greater. So when a company wants to borrow at scale, the market says, sure, but use dollars. On an ordinary day, this looks efficient. The company gets cheap funding. Investors get dollar assets. Banks earn fees. Everyone smiles like they are in a consultant's PowerPoint presentation. But once the dollar strengthens, that company's local currency revenue has to chase dollar debt that is getting heavier. Debt has no empathy. And that is only the first domino. The second domino is banks. Global banks act as bridges between people who have dollars and people who need dollars. The problem is that dollars do not move around like suitcases full of cash. Dollars move as claims, deposits, swaps, repo, and short-term instruments. This is what is called dollar funding. It sounds boring because it was practically designed to sound boring. If it were called a global short-term debt network that can freeze when everyone panics, people would sleep a lot less comfortably. In this system, a bank can hold long-term dollar assets while relying on short-term dollar funding. It borrows dollars today to finance loans that mature much later. As long as the market believes, it works. But when trust cracks, short-term funding disappears like a friend who stops replying when the bill arrives. Then everyone does the same thing. They look for dollars. When a crisis happens outside the United States, people ask, why is the dollar going up? The answer is not always that everyone loves America. Sometimes the answer is far more mechanical. Too many contracts, debts, margins, and collateral arrangements around the world need dollars at the same time. The dollar becomes more than a safe asset. It becomes something that must be obtained to close holes. And when something becomes a forced necessity, its price can rise not because of optimism, but because of panic. Now enter Treasuries. If the dollar is oxygen, the U.S. Treasury is the oxygen tank. Treasuries are used as collateral, reserve assets, cash management instruments, and parking places for large institutional money. The entire system treats them like the safest asset in the room. But safe does not mean simple. precisely because treasuries are considered safe. Everyone builds leverage around them. The repo market is where institutions borrow short-term cash by pledging treasuries as collateral. Conceptually, it sounds clean. I have treasuries. You give me cash, and tomorrow I buy them back. In practice, it is the financial bloodstream. If repo jams, the system starts gasping. Funding becomes expensive. Dealers reduce balance sheets. Liquidity dries up. This is where the dollar system becomes funny in a way that is not funny at all. The world needs treasuries as safe assets. But the United States also issues treasuries to finance deficits. So the asset that serves as the global foundation is also government debt, whose supply keeps changing. One side of the market says, we need safe collateral. The other side says, do not worry. We have plenty of new debt for you to buy. Why does everyone keep using this system if the risks are obvious? Because the alternatives are worse. The euro is large but fragmented. The UN is important but constrained by capital controls. Gold is not flexible enough. So the world complains about dollar dominance and then keeps holding dollars. And because everyone is using the same terminal, a local crisis can turn into a global line. The third domino is shortage. Companies outside America need dollars. Local banks may not have enough dollars. Global banks can provide dollars, but only if funding is available. If markets panic, dollar funding becomes expensive. Hedging costs rise. A country that looked healthy may suddenly have to defend its currency, sell reserves, raise interest rates, or request liquidity lines. Not because its economy immediately collapses, but because its payment system is connected to a currency it cannot print. That is the difference between a country that borrows in its own currency and a country that borrows in someone else's currency. The first has an inflation and credibility problem. The second has a survival problem when markets close the door. If you cannot print the currency of your debt, the risk is that you run out of oxygen before you get the chance to explain your structural reforms. And when the world runs short of dollars, all eyes turn to the Fed. The Federal Reserve is America's central bank. Its mandate is domestic. But because the dollar is the backbone of the global system, the Fed is also unofficially an international fire department. When global dollar pressure appears, the Fed can open swap lines with certain central banks. There is also FEMA repo, where foreign monetary authorities can temporarily exchange treasuries for dollars without having to sell treasuries in a panic. These are emergency pipes. The global dollar system does not run only because of free markets. It runs because in moments of stress, there is an expectation of a backstop. Now, bring this down to the ordinary investor. If you own an index fund, this is not just a problem for people who use 3 Bloomberg monitors. This system enters your portfolio through several channels. First, stock valuations. When dollar funding is tight and yields rise, discount rates rise. Growth stocks, especially those whose prices depend on profits far in the future, begin to look less magical. Not because the product suddenly became bad, but because the price of money changed. Second, emerging markets. When the dollar strengthens, countries and companies with dollar debt come under pressure. Global investors pull money out. Local currencies weaken. Local central banks may have to raise interest rates to defend stability. Third, mortgages and the cost of capital. Treasury yields are the benchmark for many prices of money. When the treasury market is unsettled, the effect spills into mortgages, corporate bonds, private credit, and real estate valuations. So yes, something that sounds like institutional plumbing can show up as a mortgage payment that refuses to fall. Fourth, the liquidity premium. In calm periods, investors like to hunt for yield everywhere. But when dollar liquidity tightens, the market suddenly remembers that liquidity is not decoration. Liquidity is the exit, and the exit always looks big enough until everyone tries to leave at the same time. History shows the same pattern. The global financial crisis and March 2020 looked different on the surface, but structurally they were similar. The system used safe assets as a foundation, built leverage on top of them, and then acted surprised when everyone wanted to turn that foundation into cash at the same time. This does not mean the dollar will collapse tomorrow. The death of the dollar narrative is usually too lazy. The system still stands because its network effects are extremely powerful. The more people use the dollar, the more useful the dollar becomes. The more people have to use it. That is not love, that is lock-in. But saying the dollar will not collapse tomorrow does not mean the system is risk-free. In fact, the biggest risk is that people confuse dominance with stability. Dominance means the system is central. Stability means the system does not crack easily. Those two things are not the same. So what should you watch? Watch dollar funding stress. Watch repo rates. Watch Treasury market liquidity. Watch whether emerging market countries have to burn reserves to defend their currencies. Watch whether yields are rising not because of growth optimism, but because of supply, term, premium, or marginal buyers demanding greater compensation. Because in the dollar system, problems rarely begin with a big headline. They often begin with funding costs moving slightly higher, collateral requirements becoming slightly larger, hedges becoming slightly more expensive, and dealers reducing balance sheets slightly. Then a little becomes forced selling. Forced selling becomes volatility. Volatility becomes margin calls. Margin calls become dollar demand. And dollar demand becomes a machine that reinforces itself. The dollar is not just a currency. The dollar is the global unit of debt, global collateral, the global reserve asset, the global payment tool, and the global panic button. Everyone uses it because the system is deep, liquid, and trusted. But because everyone uses it, everyone can also scramble for the same thing when the system comes under stress. So the next time you see a headline saying, "The dollar strengthens as investors seek a safe haven," do not stop there. Ask, who needs dollars? Who owes in dollars? Who has to sell assets to get dollars? Who is providing funding? And what happens if that pipe gets clogged? Because the biggest risk in markets is often not the asset everyone talks about. The biggest risk often sits inside the system everyone uses, everyone treats as normal, and almost nobody truly understands. The dollar system is that machine. It works quietly behind invoices, debt, foreign exchange, reserves, treasuries, repo, and your pension portfolio. When the machine runs smoothly, the world looks stable. When the machine coughs, everyone suddenly becomes a liquidity expert for 48 hours. Because in the end, markets do not always move because people change their minds. Sometimes markets move because the system forces them to search for dollars.